Hey, thanks for tuning in. Today we're going to review how to manage risk. A lot of new traders fail to understand this concept. So I'm going to take the next 5 minutes to review some topics and some tools and tricks that I use to manage my risk. So even if you have an edge, if you fail to manage your risk, you'll be unsuccessful in the long run. And that's because it just takes one string of 4 or 5 failed setups for you to blow up an account if you are not properly managing your size, not folding, etc. So what your P&L should look like is really just a slow grind towards the top right of the screen. You really shouldn't be correlated to any asset or ETF, if you do this right. So the first trick that I use is I like to have about 4 bets at a time, 4 or 5 bets at a time, based around ideas. And then I like to allocate, 10 to 20% to each idea to give you scope. Let's say I've got tech stocks, for example. Well, tech, might be, Amazon could be considered tech, just like, CrowdStrike could be considered tech. But they're both, one's a SaaS company, one's the largest company in the world. So, they could definitely both be categorized as tech, but, if Amazon goes up, Crowd will likely go up as well. And if Amazon goes down, Crowd might go down. So when you get these things that are correlated, what you kind of want to do is have these like 20, 25% max bets that are somewhat correlated or non-correlated, depending on how you want to go. Just be cautious of that correlation that may happen over time. So I've noticed, like for example, you could take something like gold and allocate 20% of your portfolio to gold and oil, like commodities, then another 20% to something like growth stocks, another 20% to your big tech stocks, and then the final 20% into more risk on assets like crypto or Bitcoin, alternatives, or something like pot stocks, for example. And then the objective would be to size those properly without having too much correlation, and focusing on the leaders in each of the sectors. So if you're going to take a space like QQQ, for example, focus on something like Amazon and Google, or the leaders that are running that particular quarter, that particular year. So that's just one way I allocate right off the bat, so that when I have to fold, for example, the art of folding here, like, how could you play in a poker tournament and win if you never folded? You can't, right? So like a lot of what we're going to do is folding a few times, right, before the market is ready to go again. I mean, I'm buying mean reversion, so a lot of the time the market's going to come back, and we think we might have a bottom, but it could be a wave 3, 4, 5 type scenario where there's one more leg coming lower, and we just counted it wrong. So it's important to, when these pivots break, to just abort the trade, right? And if you enter the trade close to these key pivots within 5 or 10%, and then you size properly, whether it's 10 to 20% of total portfolio, getting stopped out for 10%, you take a 1% loss, for example. In worst case scenario, taking a 10% loss on 20%, you take a 2% loss on total portfolio. And the idea would be that when we lose, we want to also lose quickly, right? So we want our mental capital to be preserved. We can't have our mental capital become exhausted before the trade even begins, right? How many times have you had the feeling of, I just don't want to trade anymore. I'm going to be a day trader now. I don't want to hold anything overnight, right? And then immediately the market reverses, and that's actually the start of the next bull cycle or impulse wave higher. So you got to let the mental capital go, and more importantly, you have to get rid of that ego or that desire to be right. You just have to not have that. So if you don't fold, you will hold bags. right? What's that going to do to your ability to take a new trade, right? So you got to fold. An important, number 3, just as important as folding, is holding, right? And sitting tight and diamond hands, all that stuff you hear. That stuff is correct at the right time, right? And it's a meme at the wrong time. So it's important to know that, like, hey, now's the time to be patient. You will get profit targets, right? These are just guideposts. Like, we can't predict the future. We don't know that the market's going to turn on a dime at a particular level. We have them out there because we're looking for the market to put in a reversal candlestick at those levels on volume, and then put in an A leg lower, a B retrace, before ultimately a C leg correction. So the idea is for the market to tell us when to exit, but to scale out into strength to the point where by the time we reach the final profit target, we've got 50% or less left in the trade. And when something that has gone right becomes a loss, you have a real big mental problem, right? So that remaining 50%, if you never sold anything on the trade and you sat through Penn, went from $30 to $140, or maybe you got in at $5 and went from $5 to $130, right? If you never sold and then she goes back to $50, I mean, you've missed the whole cycle. You're sitting through the whole cycle and you've never paid yourself, right? Now imagine you took 50% out at the top. Well, how do you know when to get rid of the remaining 50%? Right? Because you don't want to watch that go all the way back to $30. I mean, God forbid it's a period like 2000 to 2008 where the entire indexes and everything just went sideways for 8 years. So that can always happen, right? So you have to have a good sell signal to let you know that the trend is done, right? I like to use weekly simple moving average 40 or 50 as the clue. The slope of that moving average, I want to see that moving average roll over, and I want to see price find acceptance below the moving average. When all of those things happen on the weekly chart, you start to get the rollover look, and that's just one of those things where as a swing trader, I start to look for a different sector, a different stock to play. And finally, the last way to manage your risk here, right, is the ETF versus the stocks, right? If you've got high beta stocks, you love to play, leveraged ETFs, the triple QQQs, on the way up, it's great, right? You get these insane rewards, but on the way down, I mean, you're looking at 70%, 75%, 85% corrections. Because at the end of every 5-wave move, you will have a period where you're looking for anywhere between a 50 and 85% correction, and it be perfectly healthy. So when a trade has gone in your favor, right? Let's say you entered that Penn trade at $5 and she goes to $130. Well, now your entire P&L is correlated to one chart. 2, your risk is very high because if that stock goes down, your entire P&L goes down, and if that stock goes through any type of bear market that's prolonged, 6 months, etc., you will have an exorbitant amount of capital tied up in that, i.e., dead money. Even if it's sideways, it's dead. So what you can't have happen is as a stock moves so far in your favor that you never sell, because that in and of itself is a risk. So even when you are right and you're in a bull market and you're sitting tight, your risk increases because you've never sold, right? So if you're into the leveraged ETFs, the meme stocks, the beta stocks, the stocks that move real quick, the Tilrays, the $300 to $3 and then $3 to $70, then recognize that your stock selection process is in fact increasing your risk. And when you do sit through a correction, if you are in the leveraged ETFs, the beta, the meme stocks, the corrections will be closer to the 85% of that wave 2 than the stronger ETFs that are more along the lines of a 10 to 15% correction, under normal circumstances, and worst case scenario 35 to 50%. So those are the 4 little tricks that I use here to manage my P&L. My P&L looks something like this, right? And if you don't fold, if you don't size properly, you go 50% into one asset, you never fold, you never take profits on the way up. So even when you're right, you don't reward yourself, and it eventually turns into something that's wrong, and then you don't fold, right? So that whole, psychologically, your mental capital becomes exhausted. You can't look at things objectively, and ultimately you get trapped in your own process. So if you have any questions, if you like the content, hit the like button, subscribe to the channel, check us out on Twitter, MarketWizard87. Look forward to seeing you guys in the next video.